I get asked a lot about how to day trade, so here's a video on how to do it using a simple Forex strategy based on the rule of one. There's a lot of trading gurus on YouTube, all crack the code with the secret candlestick strategy that'll take you from broke to millionaire, jet skiing in Dubai or something. And I don't know if they're right or not. I'm sure some are. I've seen some do some good things, but I've worked at brokerage companies such as Oana since 2008, and I've seen the back-end data from literally hundreds of thousands of traders. And the vast majority of traders lose. But the ones that were profitable had three things in common. They kept it extremely simple, they manage risk, they stick to their rules. Based on what I learned during my time at brokers, I built this trading strategy during COVID lockdowns. It's based on Van Tharp principles and it's averaged a consistent 3% monthly return when I was sitting at home trading it. And in this video, I'll walk you through how to use it. So this is a tried and tested strategy, and it's going to give you a foundation for how to approach day trading. I mostly trade higher time frames now because of my work commitments, so I'm happy to share all the details. It's based on what I call the rule of one. So this is one market, one trade a day, one trade at a time, 1% or less risk per trade, and it requires you to only master one pattern. In this video, I actually use two patterns, but you only need the one, so just pick and choose which one you like. And also share with you 3 ways on how to level up the strategy when you get experience, which are absolutely how I trade now. And it's where you probably want to take your trading. So the core of the strategy is what I call the production line approach. And that's executing the same setup over and over again like a production line. It's simple and easy to follow, it's perfect for beginners, and it helps experienced traders too. So here's the details of my strategy up front. So for this strategy, I only traded USD Japanese yen on the 15-minute chart. Really simple. But you can choose a different market and time frame that suits you. It's totally fine, it will work. I trade in the direction of the long-term trend. I take a maximum of 2 trades a day. I only have one of them ever open at a time, and my stop loss is based on the average true range indicator. So that's the ATR, it adjusts the stop for volatility. So it measures the average distance of a pip move in a certain currency pair over a certain number of periods, such as 14 candles or something like that. So we're looking at 1.5 times the ATR. So if the ATR is 20 pips, I'll place my stop 30 pips from the entry. So this gives the trade a little bit of room to breathe, but it gets us out pretty quickly if we're wrong, and it gives us a very good risk-reward ratio on our trades if we've timed the entry well. I'm going to talk about a number of indicators in this video, like the ATR. If you want them, there's a link below the video. You can just go and register. They're all free, no obligation. Just go and get the ones that we use for TradingView. And my profit target is set at 5 to 8 times my risk depending on the market. So even if I'm right only 20% of the time, I at least break even. It also means that a winning trade can wipe out a series of small losses, which is fantastic. Just an example here. So check out the screenshot of my trading account. I took $3,000 losses back to back, and then obviously a single $7,500 winner. So that not only recovers all the losses, but it puts me back in profit. The key here is understanding that losses are a normal part of trading. What matters is sticking to your system, even when your mindset is shaken. So with all that information, where do you start? You start by analyzing the long-term trend. For example, if I'm trading on the 15-minute time frame, then I want to enter into trades that are in the same direction as the trend on the daily time frame. You could change this, it could be 4 hours, hourly. For you, I use the daily just to keep it simple. To do this, I'm just looking at the Supertrend indicator on a higher time frame, and that's just going to give me the direction. Nice and simple. I tend to like the settings of 2 and 7 on the daily charts. Settings of 3 and 7 also work, but you're going to get stuck in some periods where the trend can move against you for quite a while. Settings of 1 and 7, not bad, but sometimes you can get whipsawed a little bit out changing direction too quick. So I find the 2 times 7 makes for a good balance. Once I've locked in the overall trend, I'm looking for what I call low volatility breakouts. To spot these, you're going to look for those sideways quiet price ranges that form within a bigger trend. The tighter and the longer the consolidation, typically the more powerful the breakout. So it's a little bit like a spring being compressed. Wait for a decisive candle, not just to touch, but to close beyond the outer Bollinger Band. Now, if you want, you can use stop entry orders here to enter, or you can wait for the candle to break out and then place a trade. Often stop entry orders will work out better, but it will mean you get whipsawed out of a few trades that you would have avoided if you just waited for the close over. So high profitability using the stop orders, but a little bit lower win rate. For failed breakouts, look for key support or resistance levels at the bottom or the top of the range. So if price touches the upper Bollinger Band and fails to close beyond that, you see some sort of bearish candlestick pattern right at the band's edge, then that rejection is your entry signal. You can use simple candlestick patterns like bullish and bearish engulfing, evening and morning stars, and hammers and shooting stars. These are all great for timing entries. And another tip here is you can go down to the 5-minute chart to time these entries. So price is fractal, so changes will show up earlier on lower time frames. So once I see the setup like this, it's time to place my entry. I enter, put my stop at 1.5 ATR as I've explained earlier, put my profit on at 5 to 8 times my risk depending on the market. So if my entry on USD on the 15-minute time frame is 1.40.60 and the ATR is 10 pips, I've put my stop at 1.4045, my profit target at 1.41.35. Once I enter, I then follow my plan. If it hits my stop loss, then I'm out. If it doesn't, I'm breaking the trade into 3 parts. So one part, I'm going to look to take off when the market shows it's time to take off. I'm just watching what's happening in the market. The next part, I'm going to look to take off at my target, and the final part I'm looking to let run, usually on a trailing stop. And what I do is I use the Supertrend indicators for the trailing stop. I'll start on the 3x7 setting, this is on the 15-minute chart, and I'll tighten the settings as the trade moves in my favor. Moving up to the 2 and 7, if the market goes really fast in my favor, I don't want to give it back, because those fast markets reverse quickly. They'll change the settings to 1x7, just trailing the stop up, protecting my profits. And if I get a really strong, clean, low volatility breakout, sometimes I will remove targets and I'll just try and let the whole thing run. In those trades, ideally, I'll be able to add a little bit more at the start of the trade. As the trend is breaking out, I can add to the position. Now that's a simple version of it, but before I take the trade, there are other rules that must be met. So I'm buying only above the 200 period moving average and selling only below the 200 period moving average. That's unless the market is giving me an overbought or oversold signal. So for the low vol breakouts, you need to make sure that the market type indicator is showing sideways and that the Bollinger Band relative width is below 80. During the US or the UK sessions, you can make sure it's below 100 instead of 80, just because the volatility is a little bit higher during these sessions. I'm only placing trades during the times I've set to place my trades based on my trading plan. So normally this might be 1 session or 2 sessions. So just choose a time where the market is acting how you like it and there's lots of liquidity. I'll avoid trading right before news events, but in your trading plan, your trade journal, you want to see how your trade performs around news, and you can adapt your strategy for how you handle news. It's really, really important because news is going to drive a lot of your profits and losses on trades. So you need to be careful about how you handle it. And if it's already moved in my direction for the day, I'm not going to enter into a trade as well. So if it's moved, in my case, 0.6% for the day already, then I'm not getting into the trade. The market is already too extended. Once these conditions for the trade are met, then 1 or 2 things happen. You're either going to get your entry signal, or you're going to pull the trigger, or the setup conditions are going to change without your entry signal and you just move on. This strategy is highly rules-based, and this helps protect you from a lot of those emotional traps that wreck a lot of traders, things like FOMO or revenge trading, chasing losses, things like that. To avoid taking larger losses than what you expect, you need to have a solid risk management plan and clearly defined trading objectives. And these are often more important than the strategy itself. So here's what I recommend for this. Use a stop loss, like I said. And then on any trade, you risk no more than 1% and preferably 0.5% of your account per trade. And I would have like a monthly loss limit. So I'd be risking no more than 3% of my account per month. So that means if I lost 3%, I'd stop trading. And then what I'm doing with my objectives is I'm looking to make 3 to 9% a month. So I want to potentially, ideally, make a lot more in a winning month than what I lose in a losing month. And if things go really well, I can make more than 9% in the month. So what's important with this is keep in mind that the higher the returns you aim for, the more risk you need to take. So trying to double your account, yeah, you can do that, but it means accepting significantly more downside. I can double my account in a day, but I might have to risk 50% of my account to do it. So am I prepared to do that? No, I'm not. I'm looking for slow, steady gains. So in my personal trading, I'm actually trying to make 20 or 30% returns a year. And with the chance, if things go really well, of going for a 100% year. So choose your goals wisely and size your trades accordingly. I prefer, as I said, to teach a slow and steady approach where one focuses on compounding your gains over time. The longer you stay in the game, the more you learn to adapt and separate yourself from the 90% of traders that lose. But you can't improve if you blow your account. So that's why I focus on small risk, big reward mindset, aiming to lose no more than 3% in a bad month while leaving room to make much more in a good one. And this is the foundation for consistent and sustainable growth. So consider this table. This table highlights the hard truth. A 25% drawdown requires a 33% return just to break even. So for example, if you start with $1,000 and you lose 25%, you're left with $750. Now to get back to $1,000, you need to earn $250, which is 33% of your remaining capital. However, if you have a 50% drawdown, you need 100% return just to recover. So during my time working inside Forex brokerages, I noticed a consistent pattern. Traders could correctly predict the market direction. The problem wasn't strategy, it was risk management and psychology. You can't control the market, but you can control how much you're willing to lose. And that's the difference between surviving and blowing up. Now when I trade, I level up this strategy in 3 ways. And you don't need to do these while you're learning, but I recommend that this is where you want to end up with your trading. So first, you want to develop fundamental conviction in your trades. That is, you only trade when both the technicals and fundamentals line up. And even better, when you really like something, when you really feel that feeling of conviction, you trade it and you trade larger sizes. Secondly, you want to learn to float like a jellyfish to where the opportunities lie. So instead of sticking to one market, like USD yen, you can go to where the strongest trends are and you can change your time horizon. So if the opportunity is long-term on gold, you can trade that. Use the same approach, same set of rules, but just different time frame and different market. Finally, you want to learn to add to your trades. So as a trade moves in your favor, carefully add additional positions. So the key here is to keep your risk limited by trailing the stop when you add to trades. That way you have a risk reward ratio in the trade that is skewed heavily in your favor. So I like to add more aggressively early in the trade and more carefully later on. So that's my simple Forex strategy and the rule of 1. Now it's down to you to put it into action. So you can get the free TradingView indicators. You can come and join the community. That's free. You can ask whatever questions you like about the strategy or any other aspect of trading. And then we have the Advanced Forex course 2.0, where I completely break this down, every aspect, including the trading psychology side, which is the most important side. So you can go and see that on YouTube, and we can get it from the website as well. And guys, the thing that is going to f this up for you is your psychology. So what I recommend is you start there, go and view the Van Tharp video on the 3 levels of psychology next. So thanks for watching. I hope you enjoyed this, and I'll see you in the next one.